Well, good afternoon, everybody. Welcome back for round two. We appreciate you taking time to handle your business, and we also appreciate you taking time to spend this afternoon with us. But first of all, I'd like to say, you know, our deepest condolences to the people down in San Jose, where there's been a mass murder, and so you know, it just kind of like, it kills me to think that these things continue to happen in our world. And so our thoughts and prayers to those families and to the victims and to everybody, you know, associated with the people that have been victimized. So our prayers and thoughts go to them. I don't want to start off this afternoon with a downer message like that, so let's get to something more happy, which is accounting and finance. So Christina, please take it over.
I'm glad to see people came back. I was not going to lie, I was a little nervous after having a 2-hour break that I would not have anyone back. So this is great to see. Thank you all for taking time, like Fernando said, out of your day to do the second part of this session, which changes gears a little bit from the internal or external perspective of financial accounting into more of an internal perspective from managerial. A couple of notes before we get started. I know there are some questions on restructuring for Starbucks, so I did a little search in the break about what those were from. It actually is probably should have been labeled restructuring and impairments. Most of them related to, so an impairment is when the value of an asset is significantly lost. Big amounts during COVID from stores that no longer are projecting sales or from other instances that can happen. So a large amount with those for that restructuring was due to impairments. And then restructuring from still when they were spinning off and thinking about the Tivana, I think it was, in terms of some employee severance packages, actually came through that part in the in that income statement. So I just wanted to brush up. A lot of that was actually to an impairment loss for a lot of that section for all those years, and not just restructuring. So I wanted to share that a little bit since I know there's some questions there. And we'll go ahead and kick off where we left off, which we finished up the financial accounting segment. We'll still continue with a lot of those items as far as income statement, balance sheet, all of that will continue. It's just we're changing perspective to internally, such as management and like yourselves as being owners, many of you owners of your company. How do I use this information? How do I also think about decision making with this information? So we'll make decisions about the future. We'll focus again on forecasting, analyzing the difference between forecast and actual, so variance reporting. There's no set, like a little bit less set rules that we see with financial accounting when we're recording information and, you know, what specifically is a receivable, you know, that's very specific, or accrual accounting versus cash accounting. This is going to be a little bit more fluid of what works best for your company. There'll be some tools and some principles to go off of, but generally this is going to have a lot of kind of best practices we might talk about, or just things to consider too. So our goals for the second segment this afternoon, we're going to look at cash receipts and disbursement budget. So yes, we can pull our historicals and look at cash flow statements or look at our cash income statement in a cash basis. But if we're trying to project our cash flow over, say, the next couple of months or even year, there's going to be that timing lag between when you receive income or cash in and when you have disbursements out. So we're going to look from a very small perspective, but at least understand kind of the mechanics that are coming into it when thinking about budgeting cash flow over the next year. We'll then look at, okay, now that we've completed our budgets, how do I use these to look at actuals versus budget? So variance reporting of what that might look like. And then also finally determine break-even point, some target profit, and also analyze segment reporting for a company too. All right, y'all ready to get started? All right, I've got a warm-up refresher. So something that talks about a little bit of fixed cost, variable cost, income statement, just thinking through this financial data as our warm-up activity this afternoon. Let me give you a couple of clarifications though with this problem. So you were doing a buy one, get one free. That means that previously you normally sold around 3,000 cups of coffee. Those are for full price, which were $4 a cup. If you do this buy one, get one free promotion, you are projecting that you will sell 9,000 cups of coffee $4,500 then would be at the price of $4. The other half we're assuming are all free. So everyone came in, did the buy one, get one free. So we're making a couple assumptions. You are not selling anything else. You're just selling these coffees, and you're thinking, you know, what would my projected income be? Should I do this promotion based off just financials here? Okay, I'll give you 2 minutes to look through this, 2 to 3 minutes, because there's some calculations involved. And then I'll ask you for your final decision. Should you do it, yes or no? So I'll come back in about 3 minutes. All right, I'm gonna launch a poll to let me know what you think. Should you do the promotion just based off the financial information given? We'll keep it open for a little bit if you're still working on it, but just let me know yes or no. I'll keep it open maybe a little bit longer as you kind of finalize your final answers, and I'll y'all, this is we're almost, I'm just going to share this now. It's a close one. We are on 55% yes, 45% no. So let's walk through kind of some different things that we'd want to consider for this. So there's a couple, you know, as we think about variable and fixed costs, and then also other items that aren't in this financial information that we might want to model to going forward. So first off, let's see kind of where we are first at before we think about doing this promotion. So first off, we were selling 3,000 cups of coffee a month. So those are sold for $4 a piece. So our revenue would be $12,000 as our revenue, the starting point. Every cup cost us $1.50. So that would be 3,000 times $1.50. And that leaves us with 4,500. I would treat these as our variable costs. They change, total changes based off of the more coffee cups we sell. Our fixed costs are $3,000 a month. Those aren't dependent on number of sales that we have. So just a flat fee of a $3,000. So our current income, kind of what we're comparing against, is $4,500. Now, if we have the promotion and based off of kind of our projections we have, we are selling 9,000 cups, but not all of them we're getting full price for. You can think of this as each one's half price, or that we're really only getting full price for really half of them at $4. So that would be a total of higher revenue of 18,000. So we are seeing our sales increase even with the buy one, get one free. But the cost is still the same. I'm not getting any discount. I still have to make the same amount of coffees. I still have to have employees. I still have to have, you know, the cost of the beans and cups for all 9,000 ones that I sell. So then my variable cost here becomes 13,500. Now the fixed costs, I have quite a bit more advertising that I'm spending. That's not going to be variable. It's just, you know, a different fixed amount because I maybe increased my budget for it. That fixed cost then was the 3,000 plus additional 2,000, so 5,000 for fixed cost. And I actually end up then at $500 of a loss with this promotion. Again, assuming we make a lot of assumptions as we look at this example though. So based off financial information, yeah, maybe maybe I don't want to do this, but also there's a lot of other things that we haven't taken into consideration with this example, and things that you might want to think about and include in your forecast or model as you're deciding for this. What are some other things that y'all thought of that, hey, to make this a better forecast, what would things I want to consider too?
I mean, I didn't go off of just strictly financial because it was so close. Like, so my thought was, you know, $500 advertising expense or something like that in terms of the additional people that we're bringing in the store. We got 1,500 people perhaps and that wouldn't be 1,500 absolute, but there's some number of people who we've now brought into the store with the promotion that perhaps we didn't have as customers, and hopefully our product is good enough that you get it on their lips that they say they want to come back and become a customer. So I just kind of looked at the $500 that way, but that was just sort of my thought.
Yeah, no, it's a good thought of all the extra things that you could be getting from those future customers too.
In my experience, when I was in the hospitality and the food and beverage industry, I never saw where these coupons created any return business. I saw a lot of this, cost going up, but it wasn't a recurring business that was built. It was always just kind of people looking to get 2 dinners for the price of 1. And so and this is my personal piece. I'm always hesitant when I see these 2-for-1 deals, just from the standpoint that I've seen it where it doesn't work from a financial perspective, where it doesn't pay off, and it definitely does not create loyalty going forward, right? So, but in thinking about the 9,000 people, it would obviously, in this instance, it creates the foot traffic, but the cost is still the increase in variable as well as in fixed. It just kind of eats that up, right? So. I just don't see how this would be of any value, and I have to be very honest. I can't see beyond the fact that it's not making money, So I'm trying to think about it a little bit more openly.
Carla, I think you
It would be good for like a brand new business, so people can get an addiction or come to where you're at and find out where you're at. But after that, it's kind of a slippery slope, and people get addicted to only coming when there's the buy one get one free. So use it sparingly.
For me, I'm looking at it, and it's not just that you're losing $500. You're really losing $5,000, because you're losing your $4,500 in revenue that you would normally gain. Plus, it's costing you $500 to run the promotion. And I'm struggling to see that you're going to get that kind of value back in return customers.
Can I say one other thing that I didn't layer on the first one? When I'm thinking about buy one, get one free from a coffee perspective, I don't know how many people actually save coffee. So in my mind, it's like, you bring it back to the office, you give it to one of the people who you work with or something like that, right? It was just sort of my thoughts. So maybe there was some additional folks that perhaps aren't your customers that are now getting introduced to the brand. So you kind of slice it a couple of different ways, but that was just one of the things I thought about. Like, I don't save coffee, so maybe some people do. I don't know. But if I was to get 2 cups, I'd have to figure out what to do with the other cup, because you're getting them real time versus, a coupon for redeeming the second cup later or something. So anyway.
Yeah, Xavier.
Complimentary sales. So while they may be coming for a free cup of coffee, you may be able to project. I think this is what Hanifa was speaking to, is that when someone comes in, is there an average spend? Because that extra foot traffic, if average spend goes up, that could offset the cost of the promotion.
And I think, Carla, did you have a point too?
Well, I guess I just wanted to add, most often than not, when I am speaking to business owners, they go, oh, I don't like doing those Groupon promotions, but the customers are always going, oh yeah, Groupon's great. So depends how you're looking at it.
Yeah, great. Good points, everyone, as far as pros and cons. And I think that's the most important thing to take away from this is I think there are a lot of things that this, mini analysis is missing from, if you can add that in. But in terms of, just understanding that, hey, there is a cost associated with doing with this. And this knowing if I'm willing to take the, as we talked about, like the cut of close to $5,000, if that's something that you're willing to be able to take as like an advertising marketing cost, then there can be benefits from it. But just knowing the impact before really jumping into something and knowing how that'll impact your financials going forward. I know we used to do a promotion at Holland every year for one of our Alaska trips, and everyone expected it every single August. If we didn't do it, we were like, we're not going to sell these. It was a buy one, get one. It was buy one, get one 50% off, which is huge for like a $600 product. So it just becomes an expectation sometimes too. So just be, definitely thinking about those impacts it can have too. All right, so speaking of also impacts on the cash side, so now that we're thinking a little bit in terms of how do I make these decisions? How do I think about also projecting future cash flows too? This is from production kind of perspective. This doesn't apply to lots of companies that don't make goods but sell services. But we're going to really focus on cash budget, just thinking about some of the things that impact it. Every time, no matter, I mean, from at least my experience, sales is always where we have to start. At Holland America, we couldn't do any of our budgets until the sales budget was finalized because we needed to know how many passengers we expected before we could know what ports we could go to or how much those ports would cost or how much other spend was going to be. So that's kind of our biggest number that we're going to start with, that takes in a lot of different perspectives that go into it. If we're actually making something, then you also have production budgets and materials, labor and overhead that goes into it. In terms of though any other type of products or items, even if you're not making it, it still involves purchasing that amount and spending cash on those inventory purchases, and then receiving cash at different times for those sales. Then we also get to a budgeted income statement and balance sheet and selling and administrative expense budget, but we're going to focus on really kind of two components of cash budgeting. I'm talking about receivables and payables and just thinking about how those line up in terms of timing of cash flows. So deeper dive into the cash inflows and outflows. As we think about really our cash flows, it goes back to the cash flow statement too about our operating section, really talking about payments to clients, suppliers, employees, taxes. Investing is from all of those long-term assets like equipment and buildings, and then financing, thinking about in terms of equity or debt that would be kind of supporting our business and giving us capital into our business. So this is going to be the last time that we use our Excel file. Everything else will be back in the slides, but there's a couple of things that we'll go through. We're just pretending we're selling cookies, very simple, one product company, very small amount of, we're not including all our expenses, but just to keep this simple as we go through. I know many of your cash budgets will be way more involved with this, but at least gets you kind of thinking about modeling cash inflows and outflows. So if you have, we're working on the blue tabs now. So just as a heads up, if you want to follow along, like I said, though, I'll send out a completed version of it too. All right, so we're imagining we're selling, one product. We're just selling cookies, and this company is very, very small. They don't have very much at all. So just know that there's a lot more to this than what I just have here. But we begin with $40,000 of cash budget to begin with. So that's how much cash they have on hand. We're trying to get our cash inflows, which would be collections from customers. The issue is all of our sales are on account, so we get paid in different periods. So we can't just put all of our sales as the cash received in the month of April. So that's the first thing we're going to have to look at is how much cash do I actually get in April? Then I have lots of disbursements I'm going to have. So this company is making cookies, so they have materials that they have to buy. We're going to assume they just buy all the materials from one supplier to, again, make it simple, but everything they buy is on account. They don't pay anything in cash, most of it not in cash immediately. So again, we have this timing difference. We're going to assume direct labor is paid in the time period just to keep it. So everything that's worked in April is paid in April. They have some equipment purchases. We're going to assume all that's with cash, some rent and other overhead. And then this basically gets to, am I at less cash than I, actually brought in? Did I spend more than I received? And if so, we're going to have to figure out if we have to borrow some extra cash. So looking at just 2 months in isolation, but the biggest thing is this timing between disbursements and receipts that are coming in. So there's just a little bit more information around here about that they want to maintain a minimum cash balance still of $30,000 at the end of each month. So if we don't have enough receipts coming in, we might have to take on a loan for that period or for extended time. So the first question here is, okay, well, how much cash am I anticipating to collect? This is a budget, so we don't know exactly how much we're collecting, but we can look to past periods and our sales budget to see, okay, well, what might we expect that we collect? So we're assuming that their projected sales, our sales team, or maybe you have decided based off historicals, this is, what I'm estimating to sell every single month. Again, we're selling one item, so just putting this in a dollar form, this is how much sales in dollars I'm expecting as a company to get. Now, the issue is with trying to determine, well, how much of my sales are one, on account that people don't pay me immediately, and two, then if I have any on account, what's my typical collection period? And so this is usually running historicals to say, how much of my receivables, when am I actually getting that cash in? So assuming you've done that analysis, we get some general assumptions then. So that would take the first step. Okay, what are my general assumptions? Maybe 70% I collect in the current period, which would be lovely, right? The sooner that we collect it would be great. Maybe 25% I collect in the following month. So that would be the month after. And then also there's probably some percentage I might never collect if I'm selling things on account for companies that might never pay off those invoices. So I'm going to use some sort of amount there to estimate how much that would be. So if I'm looking at the month of April, I have some receivables from March that are getting paid. So I'm getting that cash in April. And then the 140,000. So this amount is coming from March that I'm now collecting in April. And then the sales in April of 200,000, I'm expecting to collect 70% of that in the month of April. So instead of taking this 200,000 forecasted sale as my cash receipts in, it's actually quite a, significantly less than that of 170,000 as my prediction. If I go to May and look at that, I'd say, well, okay, if my expectation of April amounts is that I would collect 25% in the following month, so in May for those April sales, I would just take that sales basically times the percent I think I'd collect in that future month, would be 50,000. And then we'd also want to add what we're happening in May. Okay, how much am I anticipating to sell in May? And I would get 70% then of those sales. So now we're at about 400,000 in May that we would anticipate as cash to collect. Again, quite a bit less than our sales. This could be more or less depending on kind of what the future months or past months look like. But that would be, again, an estimate of my cash inflow. And then I'll just do one more month for June, which would take then what's left over of May. So the 500,000, the 25%, again, the leftover amount that we expect to collect the following month. And then also the amount in June. So that 300,000 of sales. Again, assuming collection is kind of the same across them, that would give us then a cash collection of 335. So just a difference, especially with timing. This could be months rather than just current month and next month, but just tracking and estimating when those cash flows come in. Okay, before I go back to the main tab and bring this in, any questions on kind of that calculation or thinking through that collection process? All right, so we go back to our cash budget of just thinking of what we would bring in then. For April, we would be linking to then that cash collections for April, not our sales for April, but what cash we'd actually think we'd collect, which would be coming from our April amount of 170. So that gives us now total cash available of 210 for that month. For May, it would again be linked to then the amount in May that we think we'd collect at the 400,000. So that gives us basically a starting point of all our cash, current cash balance plus the additional amount we'd get that month.
Christina?
Yeah.
Can you go back and explain how you got the 140?
I took so whatever we sold in April, I'm making the assumption that I'm going to collect 70% of it in that month of sale. So it's multiplying by that 70%. So now if we go back and think, okay, here's all my cash I have available, but I'm going to have a lot of disbursements that are probably happening at different times too. One of those might be for this company, all of the materials they're purchasing. And that's going to be based off of how much they think they'll produce and what they want to have left over on hand. So assuming I, again, figured out how much, we're just going to say flour as the one ingredient that we're buying. I know there'll be more, but for that, we would say, okay, well, we have all of these budgeted amounts that I expect to be spending, but I don't pay them all this month. I pay 40% in the month of purchase and 60% usually the following month, depending on those probably invoices that are coming in and the length of time for those invoices. So if we have all of our basically projected amounts that we budgeted to spend, well, that's how much I might be, buying in March, but it might not be all that I'm paying in March. And so for, actually, we're going to look April, May, and June again. For April, it's going to be 60% of whatever I purchased in March. So I might have received the flour in March, but I'm not going to pay it till a later month. So I want to show that cash impact happening in April. In addition to the March materials, I also have April materials that I'm purchasing in April. But again, I'm paying that invoice the following, some the following month and some the current month. And so that's around at that 40% for that April. So now for April, I've got about 16,000 that I'm spending in cash, again, budgeted amount that I would anticipate to spend. In May, just kind of continuing on with that, we're going to have leftover amounts from April. So if we take the April amount times then the 0.6, because that's how much I would be collecting in the following month of April, so paid in May. And then also the amount in May times then the 40% that I've, again, expected to pay that current month. Same thing that would happen for June. Again, we're trying to get the timing of when we paid the cash. So we'll take these April and May numbers then, noticing that April is, actually in this instance, less than what we would have had in our expenses, but the cash outflow is a little less because we're pushing that to a later month. So bringing that to the cash budget to our direct materials would just be an outflow then for April of 16,083. So not the expense, but that actual cash outflow. And then lastly, we have direct labor that we're bringing in. We're just going to assume that it's the same amount every period, paid in the same period. So we'll just bring in our April amount here of 97,500. And after we've got basically, you'd have lots of disbursements, but again, it's the timing of when those disbursements happen to make sure that, hey, I'm in a deficiency right now of negative $96,000. I have a lot more expenses that I'm trying to pay this month than I have cash coming in. And so it's important for this timing sake for the income statement to know your revenues and expenses, but from a cash flow perspective to know, hey, do I have enough cash to be able to pay for things next month or to pay my employees this month, which, might mean I can't buy this equipment this period, or it means that, hey, I need to look for additional financing in that period. So that's where now in this instance, hey, I want to have an ending balance usually of 30,000 every month. Well, I'm going to have to do some sort of borrowing if I'm not able to sell additional units or drop any costs. And so that just takes, okay, the amount that I'm going to borrow, again, many things would go into this factor, but I want to at least borrow what I need that month. Plus I want to have 30,000 left over. So that's why that number becomes around that 126. So I'm going to pause here for a little bit, just check in any questions on kind of thinking through that process of matching up those cash inflows and outflows.
Christina, the assumptions that you've made, the general notations that you've made, is this based on your history of how you've actually operated your business in the past, or is there something else that you look at?
Yeah, exactly. So that's what that would be the main thing of historical is what has been my cash collection in the past based off, you can use it on general percentages of how quickly. So it'd take, first step would be essentially looking at all your historicals to get these rates on average, and then apply that to your cash budget going forward. And updating those historicals is important to like continually look at. So it's not just, hey, I set this and this is the same for the next 5 years, because you could have new customers. You can have change of how customers are paying over that time period, especially if you change your invoice time period too, that can impact definitely how quickly people pay you too.
Christine, and that you kind of answered the question right there. If you were to reduce your sales price by, or your terms, let's say go to a net 30 or something to give them a carrot to buy it on, and you reduce your sales by let's say 2 or 3%, could that offset the potential costs that you would have to finance for that week, for that month?
Sullivan, let me know if I'm going to repeat the question, and then let me know if this is what you're asking, to make sure we're on the same page. So can I ask them to pay me a little bit less if they pay me early or within 30 days, give them a discount almost on the sales price, because
Yes.
that might be a better deal than the financing cost of taking out a loan?
Exactly.
Yeah, and that's actually, oh, you read my mind of our discussion question we're going to do in our groups, which was exactly, how do I encourage prompt payment? Like, how do I deal with one customer's not paying me back, or paying me back really late, or how do I get cash sooner? And that's definitely something to consider, is that, decrease of essentially a discount for paying a little bit early. Like if you have a 1% discount for paying within 10 days versus the invoice date, which is in 60 days from now. The one downside to that is, I would say, from talking to other some business owners, is that companies will expect that going forward. So the moment you start doing it, it becomes an expectation that's hard to go back from.
Okay.
But it can be definitely bringing in that cash sooner. I mean, it's time value of money for those 10 days for a company. On the customer side, it's usually a great deal for them. If it's the ability of like a 20-day, basically that interest for just paying 20 days early can be, a pretty good thing to take advantage of from the customer side.
Okay, thank you.
Yeah, it's a great question. And actually you led us perfectly into our next discussion too, which I'm going to switch back to the slides here, of just thinking through our next breakout room and actually expanding on Sullivan's question there in your groups, and sharing what ideas you've experienced or ideas that you've seen with prompt early payment or on-time payment for customers. So the questions, and we'll do breakout rooms a little bit different in the second half, but the questions in your groups are, what are example or factors you consider when you're trying to do your sales forecast? I know many of y'all are in different industries, different markets, very different things you're forecasting, but some things that you might think about, seasonality, economic impacts, those type of things. And then two, back to the payment question that Sullivan had, what are some other ideas that you've come up with, or things that have worked or haven't worked? And then, just any best practices in cash collection, whether that be invoicing or receiving cash, because I think there can be a lot of things that become so important, right, with collecting that cash and paying it too. So I think I've got the breakout rooms to work. That was my fault earlier. I did not click a key button for whenever to choose your breakout room. What we're going to do is we're going to go into breakout rooms of 4 people into different ones based off of your comfort level. So if the room has 3 in front of it, that means very comfortable, 2 semi-comfortable, 1 not as comfortable. Feel free to go. There's a couple different options when we open them up. And then in your breakout rooms, there'll be new people. So your name, pronouns, again, company or industry you work in, and then, something to get to know each other. So maybe favorite food or restaurant. I know we're in many different cities that are joining us, so something that you recommend. And then go through these 3 questions, and we'll come back. I'll probably spend about 7 to 8 minutes in the rooms just discussing and sharing ideas too. So let me see. Hopefully this works. Okay, you should hopefully be able to choose when to join. Max of 4 people in each room. Level 3 just means, hey, I feel really comfortable with financial information. 1, not as much, and 2 is kind of right in the middle. All right, welcome back, everyone. I know we all didn't get to hear what the groups were talking about in their individual breakout rooms. So is there anything that I know we had about 3 or 4 groups, anything that each of the groups want to share as kind of either best practices or things they talked about for early payment or sales factors to share with the rest of the group?
Just as our group was closing out, we had a interesting thought. Is everybody taking into account depreciation and amortization in reality, or we spoke about a laptop of the cost of $2,000 over the 7 years. Are people really doing that?
For depreciation?
Mm-hmm.
Do you want me to ask it for the class, or do you want me to answer?
Yeah, so what are the thoughts on that? That's what we were asking each other.
I think our CPA expenses it for, it's just an expense that reduces your income in the year you buy it. So our CPA does.
For computers, Tom, is that what you're
Yeah,
referring to? Yeah.
For anything that small, if
Yeah.
that's considered small now, I guess.
Sure.
What's considered large? I mean, I guess that matters, but I mean, I'm just curious, is that $5,000? Is that, I'm just asking the question. I was just saying from our standpoint, we get a new employee that starts, we'll buy him a desk and a computer and we just write it off that year. Like when that amortized, not across, depreciating across 3 or 4 years or something like that. I mean, we're pretty infrastructure light based on the business that we do. We don't have warehouses. We don't have, inventory or anything like that. So that was kind of, everybody in our room was in services. That's kind of the space that we were in. But obviously if other folks are in other businesses, then that might be something more significant for them.
It depends on the year sometimes. If you make a lot of money and you buy 2 vehicles, they might, for taxes, the CPA might let you expense it and pay less taxes. But if you had a losing year, then you might capitalize those vehicles and move that expense down the road.
Yeah.
Yeah, that's a great point from tax perspective of seeing what your income or loss is, what you would carry forward or use in that current year to offset. Yeah, I'm curious, that's a great question also brought up of like what that limit is, or what is a large expense, in terms of, especially a service industry or just any type of industry. Is there a benchmark that y'all have between, capitalizing, putting something as an asset versus expensing it right away for accrual accounting purposes?
I depend on our accountants to tell us whether we're gonna capitalize or whether we're gonna expense. So
yeah, see, I think that's fair. That's right.
I think the CPA you just kind of trust that they know what they're doing. So.
Yeah.
Because, like, for example, Carlos' point, we expense the laptops, but we also amortize we depreciate the company vehicle, right? So we amortize it over. We do straight line amortization, right? So over the life of the contract that we have to pay it off. So, but that's how we do it. And then other equipment like technology, depending on when we bought our phone system, it was $14,000, right? So we amortized that over several years. So big purchases like that, I think we're amortizing, but I just kind of depend on Ryan and Carol to say like, okay, for now we're gonna, and I asked the question, right? That's why I think, to your point earlier at the very beginning of the session, Christina, this class is so important because these are the questions that we have to be asking our accountants, right? And so we don't have an in-house accountant, but these are the questions that we have to ask our accountants, so we have a better understanding of what our financials look like.
Yeah, that's a great point. Just coming, speaking the same, the language that's similar between for that accounting language, and just asking those questions for large companies. So to give you a perspective of like a Starbucks, anything less than, some of theirs is anything less than 5,000, like don't, expense it. Like, don't even think about it. If it's a $5,000 or less, cost, just expense it right away. And then the bigger purchases, and that can be, right, that materiality or level that's important to you can be different for every company, but it does take time to track it and match it, that expense or that depreciation expense to the revenue. So most likely larger items. So if you bought a building, for example, that would usually be depreciated for 30 years. Or a vehicle that can be expensive, delivery van can be depreciated, over the 10 years or whatnot. Any other groups that brought up any other questions or insight that they came up with?
Christina, can I go back just to the worksheet that we were working on, because one of the common practices that our MBEs come across consistently is, companies are now doing 60-day payment terms, 90-day, in some instances, 120 days, right? Do companies do that purposely so that their bottom line increases and it shows their stock value at a higher rate? I mean, that's a game that I feel that a lot of the corporate members play, and it's playing on the backs of the MBEs on this call, right? Because they have to pay their salespeople, they have to pay their overhead, they have to pay for all their expenses, and they're not getting paid for 60, 90, 120 days. Is that something that when you were a tax accountant or when you were working with Holland, is that something that you would see as a normal practice? And what are your recommendations in terms of prompt payment maybe being one of the ways to offset it? What are your recommendations on that?
So yeah, I think, in terms of from the buyer's perspective in this, and the ability to pay over long periods of time, like the 60, 90 days, 120 days. I mean, from their perspective, it's great, right? You have this 90-day free loan. It's better than having to take on cash and pay a bank for that loan. You have essentially a loan for those 90 days. So that is really nice in that perspective. I know we used to have this quite a bit with our Alaska, because when I worked at Holland, our Alaska group was on a short season. So, they're paying people, all year round, but they're not getting actually, they work consistently during those 4 months of the summer was the biggest time for us. So I think that relationship was a really important part. I mean, we were pretty much their only client, so it's a little bit different. So when you're your only client, you need those people to be supplying you. You have no one else to go to. So that invoicing, hey, we need to get paid soon, it's a lot easier to say when you both rely on each other 100%. It's a little bit different, right? When you have multiple suppliers that can offer the same thing, and how do I compete with other, people that are able to have that length of time of cash? So I don't have a great answer, because I think it's in that position, if you could take 90 days to pay, you're going to take all 90 days. There's no reason to pay early in a cash flow perspective from the other side, because it's a free loan to you. So yeah, that's what I'd say from their perspective. Now, how do you combat that from the other side? In terms of, we kind of talked about prompt payment, of encouraging it with a discount, or I think Fernanda, we had talked about also, that interest rate, if you don't pay on time, you're going to have to pay extra, because we need to set that, we need it within 60 days and you have to pay that interest if you're late.
So I think too, Fernando, I mean, you hit it. That's a third rail right there. I don't know about for a lot of people, but that is a major issue for smaller firms. I think, when you're talking about small and disadvantaged firms, I think that's part of the conversation that's got to happen up front, right? You can't, a Fortune 500 company should not expect you to be banking them, right? The whole paper for them. It just doesn't quite make sense. I don't know if you guys are familiar with what's happening right now in the advertising industry around Black-owned media. You can go look it up. Byron Allen, there's a lot of rattling the cage right now, but GM just made a major concession that they're going to pay 50% up front, and then they're going to pay the other 50% within 30 days. Which is huge. I mean, that is a dramatic step. And so I'm hoping that other companies will start to follow that lead, because we've had to walk away from some business because we just couldn't hold paper for 90 days, right? Somebody comes and is hey, I want you to do a $1 million media buy. Well, I don't have $1 million that I can pay, and then float that for 90 days, right? So although that would have been a great opportunity for us, the reality is we just couldn't do it. And so we've lost some opportunity. Then if you factor your paper, they want 4 to 5%, you might only be at 10%. So now you've lost half your profit margin, even though, you've done the work. So I just throw that out. Hopefully the tide is changing. And for those who are struggling with that, you might want to sort of point to that change that GM just made. And maybe that's an indication to others that they need to change in terms of the way that they're doing business.
Benny, recently I
Insurance.
heard something that really kind of bugged me, right? And that was that the biggest lending institution in this country are small businesses, right? Because of this float, right? So all these companies are taking advantage of small and disadvantaged businesses because of this float, right? This is 60, 90, 120 day float. And that's disturbing, right? But to your point, all we need is one major company like General Motors to do what they just did. And I guarantee you that Ford and Chrysler are going to follow suit, because they're not going to want to be left behind, right? So now that's going to drive Toyota, that's going to drive Honda, that's going to drive Volkswagen, right? So it's now that General Motors has taken that position, now we're going to see some movement in that direction. And then other industries are going to follow, because you need the chip industry to support the automotive industry, right? You need the oil and gas industry to support the manufacturing of auto bodies and parts, right? So I think that it just takes one company like GM to make that move, and others will follow. So that's great. I hadn't heard about it.
Yeah, you go look it up. It's it's gotten pretty testy in some regards. This isn't the purpose of this call, but just go and look up GM races. So GM was called races, essentially their practices. On Easter Sunday, there was an entire full-page ad that was taken out by Byron Allen and 5 other signatories. And so since then, a lot of things have been changing in the industry, which is, I've been in the industry for 25 years, so this stuff is long overdue.
Richard, I think did you have a comment to add too?
I was just going to say, in the insurance business, the way we've dealt with some of this is that we have an arrangement with a finance company. So if the assured can't pay the premium up front, we send them to the finance company. They do an arrangement, we get our money, and then they work out their payment arrangements through the finance company, and it takes it out of our hands. And then if they don't pay, then the finance company does the collections, and that's just an easier way for us to deal with it.
Yeah, this can be offline percent, because there's probably you pay a fee, I'm assuming, for the the selling of those receivables to the company.
Well, the person buying the insurance pays the fee, so that's their incentive. They have a choice. They either pay the premium up front, or they make their own arrangements for payment.
Got it. So that it's pushed onto the customer then, rather than you paying to finance those or sell those receivables elsewhere. Right. Yeah, thanks for sharing, Richard. That's definitely other things to be thinking about of, how do we structure this payment in different options. Thanks everyone for sharing too. I think this can be really helpful, just hearing what other people are going through and sharing ideas across industries too, and across this network. So thanks everyone for your ideas and in your rooms. I'm going to switch gears a little bit in terms of moving a little bit away from preparing the budgets and thinking about that to now, what happens when we're trying to evaluate how well our actuals came in against those budgets, which is going to be so important to know first, making the budgets and making sure they're as reliable as we can. But looking at variances, which can be helpful for a lot of different reasons. And I promise we will take another break here in about 10 minutes. So we'll take our halfway point break and then come back to do the second half of this afternoon. So now that we've seen forecasts and understand our costs, what happens if our costs come in higher or lower than budgeted? And there's a lot of different reasons why I'm going to be the cheerleader behind variance reporting. A couple of key ones: find cost savings. So if I budget it to be $10 and it came in at $12, well, why did it come in at $12? Could I have bought more of these items and got a discount? Did they raise prices? That's a good way to track the costs and find cost savings. Also, you can adjust strategy based off changes in cost structure or economic activity. So if you find out, oh, wow, this is not what I budgeted, how do I adjust this going forward? This happened to us actually one summer. We are doing our forecasts and our variance reporting, and we realized we were not selling nearly what we usually budgeted and what we usually happened for our tours when in Alaska. And if we would have waited till the end of the season and just done a report then, we would have lost out on so much, change of strategy and being really nimble in that summer season. So after our, we have 4 months basically in Alaska. So after month 2 that they were coming in below budget, we shifted strategy, we added more people, we're really at least nimble in that ability to respond to that. And that happened because of actually our variance reports were coming in so off from what we had anticipated. Adjusting future forecasts to also expect cash flow. So, in that instance, we weren't going to get as much cash flows from tours that we expected. And also one that might not come first when we think about this, but it's actually a really good internal control check to make sure that you're not overpaying invoices twice. This happened to us in our ports where we budgeted for, let's say, 10,000 at a port and it came in at 20,000 of actuals. Oh, what happened? Oh, we accidentally paid this invoice twice. And then working, from there about how to, again, not pay invoices twice. But it's a good check to make sure that you are paying the right amounts and not getting overcharged too. So when referring to variance analysis and just thinking about how I explain and understand the differences, it's the difference between actual and budgeted amount. So once we have our budget, we see our actuals that come in and we compare the differences between those. You might see favorable being the term that's used for anything that's better than budget. So that term's revenue is higher or costs are lower than I originally thought. And then unfavorable would just be the opposite. So differences are lower than the budgeted income. So that would mean revenue is lower than I originally thought, or expenses are higher than the budget. So we're going to see just an example, and then we'll take a break, and then we'll try an example out on our own. But typically, we might anticipate things based off of, we'll do a restaurant based off customers. And this is just one line item they're investigating, talking about labor expense for their amounts that came in higher than they anticipated. And that labor expense is broken into 2 components, a salary of $7,000 per month and extra personnel, no guaranteed number of hours, budget was $12,500. June was, so assuming that the month was way busier than they thought, actual expenditures were quite a bit higher and they had more customers than they originally thought. So there's a couple of driving factors that this variance analysis will now let us dig a little bit deeper and understand, hey, what happened? How do I adjust going forward? So at least this would, from my experience, I used to get this report actually from our accounting department every month. It'd say, hey, this is what you thought it was going to be. This was your variance. Now, please explain this by tomorrow and tell us why, because it would all roll up then to the CEO of all the explanations. So this is what you might get. You'd say, okay, my budget, it was 7,000. It came in actual, here are my unfavorable variances. Please explain what happened and what caused those variances. Before we go in though, there's a lot of factors that impact this. So we might want to first dig a little bit deeper before we just say, yeah, I just spent more money. We want to know why, what happened. And something that can be really helpful, especially if you have, customers as your driving factor, billable hours, anything that's causing your variable expenses to go up. It can be helpful to then reassess your budget through something that's kind of known as a flexible budget. So we might have our planning budget or our forecast, and then we're comparing that versus actual. So that's the report that usually is given, at least that was in my case, it was given to all the departments. But then we would adjust it based off our activity that changed. So that flexible budget says, hey, a lot of this explanation is based off of for my sake, passengers, or maybe it was based off of, in customers that came in, and that's why we had that higher cost. And so we can essentially break it into 2 areas we want to analyze from there. how much of that unfavorable variance is just explained through more people. I had more people come into my restaurant. It makes sense. They bought more items of food. I had to pay for that food. Maybe it's all related to having just more people. So that can explain a lot, but it might not explain everything or have nothing to do with it. And that's where these spending variances come in. So maybe I actually had a increase in the price of cheese, and that's what caused all of my costs to be higher if you're looking at inventory. Or maybe I had an increase in minimum wage for wages, and that's actually why, not that they had more customers, just that I paid more per customer. So I'll do a quick poll here, back to our fixed and variable cost. Let me see. Oh no, where'd it go? There we go. So this first one, if you budgeted $7,000 for the manager, is this more variable or fixed cost for the company, for the restaurant? All right, beautiful. Ended that one quick because we got 100% saying fixed. You got it. That's a lot more going to be fixed. So if I had known the actual number of customers, I still would have budgeted $7,000 per month. Now, on the part-time employees that are working, it's probably a mix of, yeah, I have to have a certain number of employees there to open the business, but the more customers I have, I might need people to stay on for overtime, or I might need to have people stay on their shifts longer. So if I actually would have known that my customers were 2,824 and not 2,500, I would have totally done a different budget based off of the number of customers. So basically this flexible budget just says, hey, let me readjust my budget for my actual amounts of activity. So this instance, customers. And really, if I was to go back and change it and know the future, I would have budgeted $14,120. So much higher, because I would have anticipated a higher cost to serve those customers. So what this can help is then isolate your explanation and also see, hey, do I need to look into my accidentally paying employees too much, or did their rates actually increase, or is it just because I had more customers come in? So what can help here is then break it into basically those two variances. So if I update my flexible budget, which would just be, hey, if I knew that I had this many customers, my original budget and my flexible would be the same for fixed cost, but they would be different for anything that would adjust. So things like variable cost. And then these variances for activity would basically take the difference of those two and say, well, if I'm trying to explain this, actually most of this unfavorable variance is coming from having more customers. But I'd be pretty concerned about this 513 unfavorable variance to my salaried employee. What happened? Was there a bonus that, we didn't anticipate? Did I actually pay this person, twice? Did payroll actually, pay them twice instead? What's happening here? It can serve as a, basically another check to make sure that your payments are looking accurate and kind of the big picture perspective. So the last part here, and then I'll take any questions too that y'all have. This just goes through and interprets basically what I was saying before with the difference between activity and spending variances. But activity is basically all going to be related to the higher activity or lower activity level. The spending variance is going to be all related to the amount that we're paying. So that might be spending less per hour on the extra personnel. So if it came in favorable, oh, I actually, spent less per hour, or maybe they served more customers than I expected per hour. So it has to do with essentially your spending rather than your activity. All right, I'll pause there for a little bit. Any questions on kind of understanding how to delve into your variance reports a little bit more detailed to make decisions going forward? So I have an example of one that I was going to have just fill in a couple and more focus on more of explaining it. But I'm going to go ahead and let's take a break now. It feels like a good part for a 10-minute break. And then when we'll come back, we'll work on this and see, what kind of insights would we get if we were running this restaurant and we did this flexible budgeting information we could get that maybe we couldn't get before. Where are you what's your industry that you're working in?
So I work for a company that does fuel management.
Okay.
And I'm their accounting manager. I have an accounting background, but I'm not a CPA.
Yeah. Yeah.
So I've just been doing it for 30 years.
Oh my gosh, you know so much. Like though you've done it all, right? I'm sure as being the manager, you've seen all things from payroll to taxes to income statements to like everything.
So I feel like I know just enough to be dangerous.
Yeah, exactly. Hey, Dr. Hundley, how are you?
I'm fine. I'm in Columbus, Ohio.
Oh,
So you're by me.
Yeah, so we're on the same time zone, 5:18. So I'll be up as long as I need to be. And I admire the fact that you're in the higher education community, but you're smart enough to know that the skill set that you have can also be shared with business owners. So what Christina is doing is you're working between the two of us, those that are working on theory and book knowledge and examples that will be in somewhere in their text, but by no means will they ever be able to deal with payments that are not 30 days late, 60 days late, but 120 days late, because like they said, they're floating the money from small businesses, and we have to deal with that all the time.
Where are you, Dr. Hundley, where are you doing
Aviation.
now?
Aviation
industry. What a shift from teaching.
Oh yeah. I took my doctorate degree and decided I wanted to do business law and deal with corporations, small businesses, and help them to be in compliance with SBA, Department of Veteran Affairs. You'd be surprised how many small business owners have no idea how to get their credentials or how to join groups like this or how to maintain their certification so that they can be in good standing with the state. So that's what I do.
Wow. So are you mainly based out of Columbus then, or do you have clients?
Now, Columbus, Utah, Washington, D.C., Maryland, and Virginia.
Oh.
Yes, small businesses that just need you as a consultant, and they just need you to walk a process through because they don't have time, they don't understand it, it's very scary, and it's paper driven. And because it's paper driven, not many people can hold on to the process to get your certification through Department of Veteran Affairs for 6 months. And they have no idea where the documents are. What do you mean you need my resume? I haven't had a resume in 40 years. I said, well, you're going to have one when I get done because we're going to create it. So I enjoy it because I work with a lot of different companies. But aviation is where I'm just coming from pre-COVID. But because of COVID at BWI Airport, half the consulting staff lost their jobs.
Do you feel like things are going to pick back up in the future, or is it still a couple of years out before that increases?
It's still a couple of years out. As a matter of fact, small business owners now are just trying to hang in there and not give up their entire staff. The company I worked with had a staff of 62 people, and he had to lay half of them off.
That's hard.
Because aircraft are just not flying at the rate, even with Southwest, which was scheduled to run 300 flights a day out of BWI. They're still not back. And then they're still working through the PPE, the mask, who's obeying the rules and not. Can we let this person on? Are they vaccinated? There's a lot of privacy concerns, actually. So I think it's going to be a couple of years before the aviation industry finds its way back to where it was pre-COVID.
Dr. Honey, I agree. I totally agree with you. And I think that the economy in general is still going to take another 2 to 3 years before we start coming back up.
Absolutely, Fernando. Absolutely. Yeah. It's going to take a while.
Small businesses across the country are having a hard time finding people. We're using day labor right now because we can't find people to work. And people are starting to give us orders, but there's no one to come back to work. And we're seeing that all across the country with our suppliers and everyone. Like our suppliers, we do swag, so pens, you know, mugs, t-shirts, everything are late because they don't have the labor in their departments to get things done and out on time. So just when you're trying to get things going and get the economy, you have a customer that has an event date, and now you're telling them, sorry, we're not going to be able to hit that event date because they're short-staffed in Ohio and can't get you.
You pronounced your name Basti?
Vashti.
Vashti. One of the problems we're having is that people, I was just reading an opinion article in the New York Times yesterday. It's not so much that people are not willing to come back to work. What we are seeing, and the article espoused this, is that people are not willing to come back to $10 an hour. So what we're having is a wage problem. So, and in small business, it's very difficult for us to raise the wages from $10 to $20 an hour, but that's what people are not willing to come back to. So they're looking for other options. So I think we're actually having a wage crisis as opposed to people that are staying on unemployment. Why? For what? It's not that much money. It's half of what you got when you were actually working. So, and it's a headache. I mean, who wants to do that every week, reporting to the state and answering these stupid questions? But it's, I think it's a wage problem. And we as small business owners, we can't compete with that. Not readily. We will eventually, but not right away.
Right. Not when it's, you know, $5 you have to increase per person right away.
That's right.
But in Washington, they don't have to look for jobs right now, and they get the extra $300 a week. So
that's not a lot of money.
No, plus your unemployment.
Yeah, but it's still not a lot of money.
It's not a lot, but some people would rather stay home and survive on it. Especially if you think of a family who's paying daycare out of their salary. Now they're not paying for daycare, they're not paying for gas in their car, and it's easier to stay home for them. It's not right, but
you got to understand that other countries have dealt with the pandemic in a very different way. The United States is the only country that minimizes its workers and its people and devalues them. You go to Switzerland and Germany, they're getting 100% of the salary that they had prior to the pandemic. So it's just a matter of the thinking that we have here in the United States. The rest of the world is not dealing with the pandemic in the way that we are. That's why our general population is suffering more than other populations around the world.
You know what I just jumped in real quick. I saw something the other day that I thought was interesting is that, you know, Amazon has been hiring like crazy. And Amazon is at a $15 hourly, pay hourly. And then they pay $34 an hour for overtime. Right. And there was a cohort of women who they interviewed who had previously been working in restaurants. And they were saying that this is the first time they've ever had steady income and understood what they were going to be making. Right. Because a lot of people in these restaurants, they're still making like $3 an hour or something crazy. And that's exactly right. They're going to come in. Right. So I think to your point, Dr. Hunley, is that these women are saying they aren't going back to restaurants, not underneath circumstances. So I think
that's what my daughter said.
that's interesting. My daughter, my daughter's just graduated from high school. She's on her way to college next year. And it's interesting, she currently works at Chick-fil-A. But she's quitting Chick-fil-A to some to go work at Amazon because she can get $5 more an hour. So I mean, it is the Amazon impact is definitely hitting some lower wage industries. And it'll be interesting to see how it plays out long term. But I just thought, you know, I never thought about that from a waitress perspective, but these women were saying that they now have a steady income and they have benefits or whatever. And so these restaurants are going to have to figure out how to address that. So back to you, Christine.
Yes, we didn't mean to commandeer.
It can be
uh,
chunky
Oh,
fish.
it was a good break. And, I think part of this is just, sharing our thoughts and ideas across each other too, and having this network. So, no.
Christina,
totally.
can I say something just before we get started?
Yeah.
I think the conversation that was just had is so important, because we just had a conference last week, and this was one of the subject matters that we discussed, right? Is the shortage of labor, and
Yes.
how the infrastructure is not designed to support people coming back to work, right? And that's what
No.
Dr. Hunley is just saying, right? And I think that
It's not.
we have to acknowledge that. And I think that, as we said, we're going to be, 2 to 3 years from kind of rebounding from this not only health crisis but economic crisis. And so I think we've got a long ways to go. And I'm so happy that we're having these conversations, because we have to have these conversations in order to do something about it. So now I appreciate everybody's comments. It was an awesome conversation. Thank you so much. Thank you, and thank you, Christina.
Yeah, it's good conversations, everyone. We'll start back. Seeing where we're at right now, 2:30, we have about an hour and a half left to finish this up at 4 o'clock. I know my time, different time for all of y'all. I'm going to change thought process a little bit on the calculations and more focus on the interpretation for this one. So what I'm going to do, instead of us trying to solve for these different pieces, is to take, assuming this is done for you, how do I take away, what do I interpret this as? So more of a user of it than really creating it. So I'm going to put, I know that's, talks about a little bit of the background. So I'll share just the background first, so you understand what this, company situation is. But actually relatable to what y'all were talking about, I was talking about restaurants, right? And like the wage and thinking about all the costs that go into it. So imagine this is a, pizza restaurant. They've got revenue, ingredients, they've got staff expense, bunch of different items for 1,600 pizzas. They thought they were only going to sell 1,500. And so we're just thinking about, well, what shifted? What did the variance report show us? How do we learn from this? What do we think and explain for this going forward? So there's some set amount of fixed costs and average cost per pizza. I had some of it already done, which is what you'll see on your side of just some blanks, but I think for time's sake, I'd rather actually spend time interpreting it. So what I'm going to give you is a little bit of time to look over this for about a couple minutes on your own, and then I'll put you back into your breakout rooms from before. But just think about, what do I learn from this? How do I interpret, for example, this favorable spending variance for revenue? Or how do I interpret this unfavorable activity variance for ingredients? And what are some things that I would think about as this owner of the pizza restaurant that think about forecasting going forward or strategy for going forward? Okay, so I'll give you a little bit of time to just think on your own here, maybe about 2 minutes on your own, and then I'll just get you into breakout rooms so you can discuss with your groups there. All right, you won't be able to see this when you go into your breakout rooms because I realize it's not in your slide deck, because I was going to have y'all work through it, but I think it makes more sense to spend time on interpreting it. So if you want to take a screenshot or a picture to bring to your breakout room, you'll be able to share your screen in your breakout room this time, because I completely forgot on the first one. So I'm sorry about that, but you should be able to share your screen this time, and yeah, take a picture or a screenshot before you head to those rooms. We'll be in the same breakout rooms that you went into earlier. You won't have to assign yourself to them though. It should stay the same. I will spend probably around 7 or so minutes. Just come with like your biggest takeaways as far as, how do I interpret some of these spending and activity variances, and what are the biggest things that I would want to know as the owner of this pizza company? All right, I think we have everyone back. So just debrief on some of the key things that we took away. So I'll ask a couple of questions, and maybe some of the groups can share what they thought for this one. Let's look at the first one for, well, maybe actually big picture first. If you were to choose one thing that you would want to learn more about, investigate more, or think about planning differently for the future, what would be one of these variances that you would want to look into?
Can we put it up on the screen?
Oh, that might be helpful. Yes. Sorry. I was pointing to it over here and y'all can't see any of it. So yes, thank you.
For me, I think the biggest thing I'd want to understand is how they got the ingredients, the unfavorable ingredient variance.
In which, any specific activity or spending or just total budget?
Total budget.
Right, any other, so we have spending, variance for pizza ingredients. Anything else from any other groups?
I'm gonna be honest with you. I was tripped up about the activity variance and spending variance and the total variance, right? They didn't seem to be consistent across the board. So if we go to net income, all of those numbers hold. But then when we go up to some of the other categories, that's not the case. So if I'm looking at pizza ingredients, there's not 420 difference between 63. Actually, it is. So hold on. So let me see. That 130 had tripped me up before. So let me figure this out. Okay. All right. Well, all right.
Are you feeling better about it?
I'll pull back my question. So we're trying to figure out, yeah. Okay. All right.
That's it.
I'm tired over here.
I know it's late. It's late. I know y'all are sticking with it. So we point out ingredients. So let's break down the one that you were talking about here of right, the difference between these. How do they all relate to one another? So if we have our activity variance all related to just selling more pizzas. We sold 100 more pizzas than we thought. We were going to sell 1,500. We actually sold 1,600. So our favorable variance for revenue makes a lot of sense. We sold more pizzas. I'm going to have more revenue coming in. Also in response, I'm going to have to pay more for the ingredients for the pizzas, maybe a little bit more utilities, maybe a little bit more miscellaneous activity. So those are all going to go in that unfavorable direction for the cost. Now, the spending variance, that becomes nothing related to making more pizzas. Has everything related to do with the cost or price or efficiency of those ingredients involved or our revenue. So for example, let's look at the revenue one. I thought, if I made, assuming my price still was, as I estimated $13 sales price for every pizza I sold. I actually got quite a bit more, I have a favorable variance. What could be an example that caused that spending variance then, since we know it's not related to more pizzas?
Different ingredients.
Okay, different ingredients that could cut, right? That would come here. Maybe our pizza ingredients were more expensive than we thought. How would that relate to revenue?
Additional toppings.
Probably do charge for every additional topping. Yeah, it's you might have your base ingredients. Hey, it's usually $13, but now I'm going to have some more expensive toppings for some reason. Onions might be, an extra $1, but it might not cost you actually $1 to put those onions on, which is why you see, not the same variance between those two, able for that markup. But yeah, that could definitely be probably the biggest reason why we see that revenue favorable, and then that pizza ingredients spending variance unfavorable. Any those are probably honestly the biggest numbers as we look through here. Our utilities come in unfavorable, which probably means some sort of rate difference too. So that could be probably mostly relying on whether that was appropriate to assign 10 cents as kind of that variable cost for every pizza that we're making. So that could honestly be a budget issue that we want to adjust. But some of these, this would be something that we could explain and say, not all of it's related to selling more pizzas. We actually do a really good job of upselling some of our pizzas. And let's think about ways that we can continue to add those toppings, because that, ends up hitting our bottom line pretty positively at the end, because we see that kind of markup between those two too. All right, nice job, everyone. So the kind of key takeaways here is that you might just be looking at this variance, but this variance right here is just the difference between your budget and your actuals. And there's a lot more details than just, saying that my pizza ingredients were $550 unfavorable. Well, now if I explain why and think about strategy going forward, well, yeah, some's related to activity, but I can also think about ways I can increase maybe those extra ingredients or ways that I can think about selling those items too. All right, that that's our last part of variances. So are there any questions on variance or analysis of those variances before we move into our very last section?
Very good. Christina, so the way that I use our variance is so I report like budget to actual, and the variance, I look at it from the standpoint of it helps me define whether I'm being efficient, not being efficient, whether I'm overspending, am I over costing myself on a particular program versus delivering it where we really plan to budget. So I use this variance pretty consistently every month as I report out to the board of directors, and it's really telling, am I over delivering service? Am I under delivering service? And that's kind of like the way that I look at the variance report that we put together. So this is a really great exercise. I like it.
Yeah, I'm curious if, is this pretty common for other folks doing variance kind of reporting at the end of monthly, bi-monthly, yearly? What are some common things people have seen?
We look at it probably every 3 or 4 months.
Mm-hmm. So we look at it in 3 ways. We look at say month year over year. So April to April, we look at the variance in terms of how we performed last April versus this April. We look at it year to date last year versus, we do a variance report there, and then we do a budget variance. And that kind of gives the board of directors a really clear picture of how we're performing overall. So, and it's not just busy work, because it really does tell us a little bit, and we can get inside of all of this stuff in terms of where's the variability coming from, right? And but it really is designed to help us kind of define, are we meeting the objectives that we set ourselves up to from not only from a financial perspective, but from a customer service perspective, or are we falling behind? So that's kind of how we. Yes.
Is it worth the energy and the time that you have to put into those different reports, or do you find yourself spending a lot of time on minutia?
No, actually, Dr. Hundley, thank you for asking that question. One of the things that we at our council really focus on is not doing a lot of busy work. So exactly. So everything that we do, and even reporting the financials to the board of directors, is designed to give them a better picture of what it looks like, right? So so no, I don't think that it's a waste of time. I think that the information that we share with the board of directors just builds confidence in them that we're being effective at what we do.
Confidence in way of them making sure that the company gets all that it needs, including finances.
Exactly.
Does it help with those kinds of issues? Because a board of directors can be tricky.
Especially from a financial perspective, especially having good financial reporting like this is so important to continue, and not only getting more money, but not only getting the money we get, but getting more money, right? So
exactly. Okay, that makes sense.
Mm-hmm.
Great, thanks everyone. Thanks everyone for sharing. And I think, you bring up some good points of focusing on the big things. There's a lot of things we should ignore here and not focus on, right? So it's limiting to like, what are my key things that I want to focus on?
Yeah.
If it's immaterial or doesn't matter, we shouldn't, spend the time. And I think that's a great point to bring in too.
And I will say that we do it in general categories, right? So we don't go through the minutia of like, we don't go through the minutia of presenting every line item when we present the budget. We go to general elements like G&A, direct expenses, fundraising expenses, and so on.
Good.
Oh yeah. No, we don't go through the minutia. Thank you, Dr. Hundley.
Good.
That it just brings up more questions probably. So
yes, it would.
All right, everyone, we are on our very last segment, which kind of takes big picture, looking at break-even point, target profit, and then lastly, probably my favorite question almost of the whole entire class is looking at, big picture, how do I determine whether what cost to look at when I'm having multiple segments? How do I know if that segment's profitable or not? And what do I do if I decide maybe I should not continue with that business or that segment of my company? What are things that I need to look at? So last segment here. Thanks for sticking with me. I know many of you, this is late in the day, so we will be finishing up here in the next hour or so. So thanks for sticking with me. So the last final part is just looking in terms of break-even point and just understanding how your costs and covering those costs with revenues that are coming in. So this was brought up earlier about terms of, looking at our income statement from a financial perspective, and then more of an internal perspective about fixed and variable costs. Break-even is essentially looking at making sure I have enough money coming in or revenues coming in to cover all my costs, essentially reaching an income of zero. Now, this can be in terms of a whole company, but a lot of times even just new ventures that you're planning to go into or new products, just kind of looking at it as how much do I need to sell just to cover costs for that new product. So we'll look at this in terms of variable expenses and fixed expenses again, because variable expenses will change and fixed will stay the same if I sell more products. So you can think of this a couple different ways. Big picture is that we're trying to get to operating income of zero. Now we'll look at it as most likely, eventually once we hit zero, we want to also show a profit in that segment too. But just trying to cover all our costs, we're essentially going to try to solve for X here, where sales price times number of units minus variable cost times number of units, and then minus fixed cost should equal zero. That is the same thing if we go back to our algebra days and move that X around, we end up with basically our total fixed costs divided by sales price per unit minus variable cost per unit. So we're trying to solve for essentially how many units do I need just to cover my costs for this new area. Now, many times that actually might look like a target profit. Instead of just reaching zero, we can say, hey, if I'm trying to hit, $70,000 this month, how many units do I need to sell to reach that target? And then not much is different from the break even, except that instead of zero, you'll put whatever your target profit would be. That then, if we again move our X around, what we end up with is this formula here that basically says fixed costs plus target profit. That's what I'm trying to cover with my margin of my sales minus my variable costs. So dividing those fixed costs and target profit, but basically by that margin. All right, so we're going to see just an example, small case example of putting on a 5K to see essentially how much would I need to break even with a sales price for each runner being $30. This was looking at our fixed costs. So all of these items aren't changing based off the number of runners that we would have. These would increase every time we have an additional runner. So variable cost per runner is $17.90, but I've got quite a bit of fixed costs that I have to cover. So I'll just show this in two ways, but essentially we're taking our fixed cost divided by that margin of 30 minus 17.9. That 30 is the sales price, that 17.9 is the variable cost. And I need 359 runners just to cover my costs. So that's just the basis kind of benchmark that we would like to set to say, hey, if I can't get that many runners, well, I'm either going to have less money, so a loss, or I got to do something with cutting variable costs, fixed costs, or raising that price, because there's no way that I'm going to be able to cover all my costs that way. And then another way to look at this, just kind of expanded, this is the condensed version, but essentially explaining what's happening there is we're taking our revenue times our number of units that we don't know how many people we need to break even, minus our variable cost times units, minus, again, that fixed cost. These are the same exact thing. It just shows it basically in two different perspectives to say, hey, here's the big picture, what's happening, and then here's the condensed version to see how we get to those number of runners. Now, not much is different if we now say, hey, I want to actually reach $10,000 for putting on this event. Well, not much really changes, except for instead of adding, hitting a $0, we actually want to hit $10,000 instead of zero. So we need quite a few more runners to reach that target profit of 10,000. We only needed 359 to break even, but our margin's not, is about a little bit, maybe 40% is our margin. So we're not getting, every additional unit runner that we have, not all that $30 is going to our bottom line. And then here it's just broken out in terms, again, expanded, so you can see kind of what's happening behind the scenes to get to that 1,184 or 85. And that's going to be, definitely you get this number and you might say, okay, well, there's no way I can reach that, or that seems totally doable. And then it gives you a benchmark to see what you can adjust going forward to. All right, I've got now it's set for y'all to try out and assess this. I think we'll kind of combine almost everything that we've done from the first half and the second half. So think of this kind of a comprehensive look at this problem here, where we've got, we're just going to stick with selling a product. They sold 12,000 pairs of shoes. So first we're going to try to find the income. So where are we starting at? And then we're going to try to figure out how many shoes, though, just to break even do I need to sell? How many do I need to sell to make a 10,000 profit? And then a really interesting one that goes back to the airline example earlier is, what if I shift between fixed and variable costs? How does that adjust with my income and my forecast going forward too? So a couple of calculations on this one. This is the very last calculation one that you have. So give it your all for our last one. We still have a couple more concepts, but they will not have this much calculation. So let me give you a little bit of time on your own just to think through it, calculate it, interpret it. I think 4 is one of my favorite questions, just thinking about shifting costs around. And then we'll go through it in a little bit in your breakout rooms. But let me know if you have any questions as you're working through it. But let's spend maybe about 4 to 5 minutes on our own thinking through it, and then we'll go into our breakout rooms to talk with our teams. All right, everyone, in about probably about a minute left in our kind of independent thinking through this. I'm going to put you in about a minute into your breakout rooms. You can feel free in your rooms to keep working on it individually if you're still working through it, but some of you might have finished, so you can start walking through the answers you got for it. If you have any questions as you're working through it, just send, put the ask for help button at the bottom and I'll jump in the breakout room. But otherwise, we'll probably spend about 8 minutes or so in those breakout rooms going through these 4 questions. And let me just double check. Yeah, share screen is now on, so that should work out hopefully well for those two. Hey everyone, welcome back. I visited a couple groups. Y'all look like you've got it based off just checking kind of the numbers that are on your share screen. So I'll walk through them though, just so we can have final versions up here for if some of y'all didn't get to the kind of final ones. So let me, again, remember to share my screen will be helpful. All right, so we were looking for a couple of things. First off was our break-even point, and we've got, or actually, sorry, first off, our income actually was the first thing. And let me see, just to see what everyone got. I've got a poll now. What did you get for your, I know the first question was asking about just your income for that year. All right, looks like we've got a couple different answers here for income. So let's see, let's walk through with how variable and fixed costs kind of change and impact that income number. Thank you, everyone. That's very helpful for me. So first off, we want to find revenues. That's going to be based off our selling price. So they are taking how many, let me remember how many shoes. I think it was 12,000 shoes. So we would take kind of like the coffee example we did earlier times $30. And that gives us revenues of 360,000. Then all of our expenses, both of these are variable costs. So they'll change based off the number that we have. So if we take 12,000 times 13.5, and we get that cost, we'll have 162,000 that gets subtracted. Our sales commission also going to be by 12,000, so times 4.5, which ends up with 54,000 of an expense. And then lastly, all our fixed costs, which we don't have to multiply by the 12,000 because they'd stay the same. And those total 150,000. So that's just the sum of these. Again, we're finding annual amount, so annual income. If we take 360, so that is our revenue, we subtract then the expenses for that month, we should have been in a loss position of 6,000 for the net income. Okay, and then the second part, when we look at break even, so we're trying to get to an income of 0. We are at a loss. So we know now we have to sell at least more than 12,000 shoes, because right now at 12,000, we're at a loss. But how much that is, we can take our fixed cost, 150,000, divided by then our margin per unit, which here we'll take then the $30 minus the 13.5 minus the 4.5. Because those are going to be all the variable costs here. And if we do that, we should get 12,500 shoes basically to hit break even. So basically we need to at least sell 500 more shoes just to cover all of our costs and put us out of the red. If we actually wanted to do, instead doing our target profit, not much is different, except we take the fixed cost plus the target profit, which was, I think it was 10,000 for this one. And then divided by, again, our variable cost in revenue, same as above. And we'll need 13,333. I should probably round up. Let's round up to 4 here, since we can't really sell a half of a shoe and we don't want to, not hit our target. So 13,334, and that's to hit the target. And then last one, our change in, how does our break even change when we change the structure? So this is a little bit of what the news article earlier about switching from fixed to variable or variable to fixed and thinking about how those costs perform. If we find our break even point, we still take our fixed cost, which we would have, let me go back here. What are we changing again? We remove the commission and increase our fixed salaries by 31,750. So I've got 150,000 of fixed costs plus the additional salary of 31,500. And then I'm going to divide by now my new margin, which is just the 30 minus 13.5, because I've taken away that commission. And now I only actually need 11,000 shoes to break even. All right, any questions as you're working through this? Or, and then, first off questions, but then second, what are other things that you'd want to, maybe consider if you're thinking about number 4 here? What are some other consequences or just other things to consider if you did make this shift? Tom, yeah.
You'd have to factor in returns, because I think 10% or whatever people return the shoe, and then you can only sell it at half the cost if it's semi-used, and that would probably be a big thing for shoes.
That's a good point. Yeah, so we'd want, as we're assessing break even and how many that we're selling, we probably want to take out how many returns we'd estimate too.
Yeah.
That's a good point. Or change our selling price, like, okay, we know we sell it for $30, so if we take into returns, it's really like $28 or something that we're getting. Anything else that came up in your groups?
We were told if we hang on to the end of the class, you could give us a lottery number.
What'd you say?
If we stayed to the end of class, we would get the lottery number from you. So I'm here to the end.
Well, you're making it. We only have one problem left, so I will sell this ahead of time. We are going to end a little bit early. I'm sorry that we're not going to the end of the mark, but I will stay on if you have questions at the end or want to run something by me. Basically kind of as like the last 30 minutes or however long people want to stay on with questions that you have. A little bit timing on this is all on my end here. I'm putting a little bit more up front and a little bit less later on. So nice job. Yeah, you're sticking on. We only have one topic left at the end. The last thing that I'll point out for here is just in terms of, switching between variable and fixed, either direction. One thing when, this kind of unintended consequence could happen, switching to this fixed cost is the commission really is it a huge incentive for the people that are working in selling the shoes? Are you actually going to have a decrease in sales? Or will it not impact it very much with that salary? Vice versa, if you go from fixed to a variable component, just thinking about, how does that change? If you keep selling more, that variable cost keeps going up and fixed is pretty constant. There's not a right or a wrong of having fixed and variable expenses and a spread between them. Just knowing though, what happens when you don't have as many sales, how does that affect really how your company's performing? All right, nice job, anyone. Any last questions before we move into our last question? Yeah, Fernando.
Christina, thank you. So if we look at our profit analysis, is there some place where we can go to by industry and look at benchmark profitability so that we can measure ourselves against that, so that when we're working on a deal, we know what a good deal looks like versus, like not having that knowledge, and then all of a sudden we find ourselves underwater, minus $6,000 in net income the first year, right? So is there a place where the various people that are on this call can go look for things like this?
Are you talking about in terms of like benchmarking ratios, that type of thing, or benchmarking
Ratios and profits? Yeah.
I might have to catch up with Will here later on when he comes there. I know it when thinking about like different, we have some available things when we're at that UW has purchased for like students to use to do benchmarking. And I'm not sure if they're available outside of that, is that a purchase from UW itself. And I know I put Will on the spot here.
No, that's okay, Christina. Yeah, so it is true that on campus, our university pays for certain subscriptions and things for databases, and those are exclusive to folks on our campus. That being said, a lot of public libraries also have, similar subscriptions that are available to the public. And so if you've got, memberships to your local libraries, you would have access to things like the RMA, which I think Christina is called the Risk Management Association. They're an organization that also puts together a series of benchmarking for financial statements, but they break it down based on what industry you're in, the size of your business, how many years in business you've been. So you really can get an apples to apples comparison to a lot of your competitors and a lot of other folks within your industry. So check out your local libraries. There's a lot of information that's available to you at your fingertips.
And Will, thank you, because to me that's really important. So we as MBEs understanding that industry benchmark, right? So where is the market saying? Because the corporations, when they're looking at us, they know they study this, right? And so they know how much profit we're supposed to be making as a business in our particular industry. And so then that's where they can get into some of the pricing and some of the negotiations. So if we go in with a target profit, then it can help us develop a range that says this range is acceptable. Anything below that is a bad deal, or anything above that, we have to analyze to see if we're leaving anything on the table, or if we're not delivering the value of service that is being requested. So I think the profit is important for us to understand how to leverage it as well.
But the only problem I had, Fernando, is in the years that we've been at the airport, because small businesses are so unique, it's very difficult to line us up exactly with another industry and their margins. So you can look at several different subscriptions, as Will said, but you'll find that we're unique. And because we're unique, you have to look at several different margins and just kind of gauge whether or not your profits are within that range, because we never could find one industry that was just like ours.
Well, that's Dr. Huntley, that sounds like something that our council needs to work on so we can develop this benchmark catalog.
Exactly.
But you're absolutely right, because you look at various industries and you determine, hey, this is a range where we need to be at, right, in order for us to be
Exactly.
successful. Yeah, yeah,
Mhm.
perfect.
Yes.
Carla and Hanifa, did you see that new assignment that we just got?
I caught your drift, Fernando.
Okay.
Good brainstorming session, right? Great, thanks everyone. So I have one last final question for y'all, which is looking at some of our costs to consider whenever we're thinking about different segments within our company, and thinking, should we, drop a segment, add a segment? How do I look at this? You can think about this in terms of clients too. If you look at it on a client basis, how do I know whether this service that I'm providing is actually getting a profit for that one client, or kind of how to compare that across your company too. Whenever we're looking at these costs between the companies, the biggest thing is that we're going to look for basically costs that are different between the scenarios. So if a cost stays the same, then it's pretty much not necessarily relevant for our decision whether to add or drop this client, or whether it be a segment of our company. Because if costs stay the same in both scenarios, then it's just something that is going to stay the same and not something we have to look into. So basically, costs that reduce or eliminate by that level of operations would be relevant. So costs that go away is really relevant to our decision. Opportunity costs. So that would be basically cost of the next best alternative. So for example, if you think about, hey, maybe I'm using this warehouse and or production facility, and right now I'm, if I rent out my production facility, maybe a space of it, maybe I can actually make some additional income rather than just using the entire facility for myself. That opportunity cost, so that next basically available opportunity, is also something to consider as you're thinking about kind of adding and dropping segments too. So what basically the cost of the next best alternative. Sunk costs, if they're historical or you can't recover any of the costs, then ignore it for future planning. If it's a cost that I can never get back, ignore it. It has no effect basically on your future determination for those product lines. So instead of sticking with definitions, I think it makes much more sense to apply this and say, okay, well, what if I'm actually given a scenario? What type of things would I want to consider? So let's imagine that you're running a bike store and you have a retail store that sells bikes. You sell 3 types of bikes, mountain bikes, road bikes, and kids bikes. You do your, end kind of summary of, you break it out by segment. So by these 3 different segments, and you've got your variable costs, your margin, direct fixed expenses are all things that are different between the different product lines. So for example, a direct fixed expense might be, let's imagine I have a salesperson for each of these different lines. And I'm trying to figure out whether I should keep this kids bike line or not. And I'm trying to analyze, whether I should keep it, whether I should drop it. How do I make this decision? I'm looking at these numbers here. My direct fixed expenses, they would go away if I drop those lines. So for example, unfortunately, maybe I have a salesperson that just sells kids bikes. They're fantastic at selling kids bikes. But if I no longer sell kids bikes, I might have to let that person go because I don't need that person actually selling kids bikes anymore. And I don't have space to convert them to selling road bikes or mountain bikes. Now, common fixed expenses, these are things like the rent on my retail space. I'm not planning to expand or make my retail space smaller. I also don't think that I can expand my mountain bike or road bike sales at all if I drop my kids bike line, because it's not that those kids, people that were buying kids bikes are now buying mountain bikes. I can't just convert them and sell more mountain bikes or road bikes. So these numbers up top are going to remain relatively constant, even if I drop the kids bike line. My net operating income as a total store, so total bicycles, comes out to $15,200. Now I have a question for you. Should, again, based off this financial information, should you drop the kids bike line or should you keep it? And I'll send a poll out. All right, looks like we got most of the answers. I'll wait another 15 seconds just in case anyone didn't get their answers in. All right, we ended with 75% said no, we should not drop this kids bike line. So I wanna hear, I mean, looks like I'm losing $2,400. So can you explain to me why I would not want to drop this kids bike line?
I guess I would think that those kids are your future customers for mountain bikes and road bikes.
Okay, so from a customer perspective?
And I'm not sure if those fixed costs for the kid bike space are gonna go away or not.
Which all of the fixed costs, a specific one?
The direct,
The common.
or the
fixed
common,
costs.
the common fixed, yeah.
Yeah, good point. So financial reason, well, if I redo this income statement and if I go through what costs are relevant or not relevant, if I drop this kids bike line, I lose out $32,000 of income coming in. Good news though, hey, I don't have to pay $16,000 as variable costs. And I don't have to pay $12,000 as variable cost. But this $6,400, these are just allocated common costs. They're gonna happen whether I keep the kids bikes or I don't. And so honestly, the kids bike segment is actually contributing $4,000 to help cover common costs. Common costs being rent, being, this could be your, general and administrative costs. So if I redo this and say, okay, what if I do drop it? And what does it look like with mountain bikes and road bikes? I actually come at a loss of, I'm losing $4,000 in my total income at this point. So it really has to do with how am I looking at the data that I'm given? And that's kind of, as we think about key takeaways from today's session is learning the information, being able to talk this information, and also being able to know what information to look at when you're given all of this to make those decisions off of. Tom, yeah.
Yeah, and another thing, it could also affect your volume discount if you're buying less bikes from the bike dealer or wholesaler. You might have to pay more for your regular bikes because you're not buying the right threshold of bikes. So
that's a good point. Yeah, it could impact maybe that also, as a extended impact makes this variable expense almost go higher for my other bikes. Which
potentially.
Is, yeah, unintended consequence there too. So just to show you kind of one other way, and then I'll, there's a couple other things to point out here. Sometimes it can be helpful to, when you think about these different segments, is come up to a segment margin. So taking, if you can do direct costs, so what's actually related to that one segment or product. Sometimes that might be difficult and there might be a lot of common costs. But now if I separate it out and see the segment margins and then take my common costs, a lot of times we might allocate it, but then looking at it this different way of saying, hey, I'm making income in all of these to help cover my common costs. So yeah, I definitely would probably want to keep it just to cover those costs that I have. Now, there are some other parts I know, Richard, you brought up, well, I also don't want to drop it because maybe those people right are my future sales, or maybe if I look, hey, everyone that buys a kid's bike, their parents also buy a mountain bike or something. And so that's a pairing. What are some other things that you'd want to think about besides things that we've talked about so far?
I would think if you were looking to be acquired, that maybe they would want a full line of bikes to be able to service or combine with their existing inventories.
So keeping the 3 lines just for the diversification of the different types of products that you have?
Yeah. Or continuity, I guess.
Anything else?
In one of the earlier examples, someone talked about what are the add-on sales, right? And I know we're just talking about 3 lines of bikes right now, but I think there's, yeah, maybe I'm reaching too far, but I think there's another line of revenue from all the, I'm not a biker myself, so if you want to ride a motorcycle, that's what I ride, but that's the type of bike I ride. But the add-on sales from other additional things like helmets and things like that. But I don't want to go out of scope of what we're discussing here, but I think that retain the kids' bike line is important for the continued growth of the overall organization.
Yeah, I think in terms, that's a great point to bring other items. Yeah, we don't consider that in here, like helmets, right? All those extra items. We might even take a loss on the kids' bike line. If we are generating enough income with bringing in other people or extra sales, we might still keep it even if we have, a segment margin of a small loss, kind of as that loss leader to bring in the other one. So there can be, definitely reasons for not just saying, if I don't make a segment margin, I should eliminate everything. But again, it's important to just know that information of where you're at. And also in terms of, really thinking about all the costs that go in, what would go away, what would stay, as you're thinking about these different items. Also, maybe these would shift. Maybe if I sell more, what's my demand for mountain bikes and road bikes? Maybe that would shift and I'd actually sell more of those if I had more space. So
you could move, or you could move to a smaller space and pay less rent if you didn't have kids' bikes.
True. Yeah, so as you're thinking about all those, it's modeling really all those different scenarios and comparing them, and also making what makes sense for your strategy for your company going forward too.
Right. The marketing person in me is saying, oh, well, I lose families as customers. And
yeah. And
Absolutely.
combining that now with the number piece just makes that right in terms of how do I validate that kind of piece of it too. Great. Thank you, everyone. This was your very last questions. You made it through the entire day. Benny, yep, you made it to the very end. I wish I had a lottery number to give you at the end. But instead of that, I have your wrap up of all the things you did. What's better than all of that new, hopefully helpful knowledge going forward? So we covered so much today. Really great job, everyone. Thank you for your engagement, enthusiasm throughout the class, both morning and afternoon session. We covered a lot of items. Hopefully this will be helpful going forward. You can take pieces of it. And like I was saying earlier, I'll send out the annotated pieces too afterwards. You can have those too.
So I'd say thank you. And I think you're a terrific teacher. You got great energy and you kept this interesting. I wasn't looking forward to it, to be honest, but it was like I need to get it done. I was going to buy Financial Accounting for Dummies book. I may still go buy it, but at least you gave me a running start. So I appreciate it.
Great. Awesome. Thanks for coming.
And you also made it less scary.
Good. Okay.
That's the word accounting is scary. Okay.
I know it can be.
It can be intimidating.
Intimidating. That's a good word to use for it.
Thank you.
Fernando, I'll hand it over to you if you've got I will stick around. I know the session goes till 4, so I will stick around. I'll let you close out, Fernando, but if you've got questions, I'm happy to answer any of those too in the last 20 minutes or so.
Well, first of all, if everybody can get on their camera, Hanifa, can you take a screenshot of the team here?
Sure.
Can everybody kind of, Gabriela, we have about 12 people left, so because I'd like to get a thumbs up from everybody or thumbs down, or what do you guys think about this, right? Christina, you count too. Yeah, so and the reason for that is because this is what we're trying to do for our MBEs all the time, right? Thank you, guys. This is what we're trying to do for our MBEs all the time, is help them develop and grow, right? And we understand that understanding financials, as Dr. Hunley just said, it can be scary for a lot of people, and we're trying to not necessarily dumb it all the way down to accounting for dummies, Benny, but get it to where everybody starts feeling comfortable, right? And it's taking that first step and really drilling down into it. So we want to take help everybody get there. But this is also something that we wanted to run because we do want to do more of these sessions, more of these focus sessions, right? So we're partnered with the University of Washington in several regards. We support the Minority Business Executive Program. that we developed with the University of Washington about 14 years ago now, and 15 actually, maybe. And so we're partnered with them there. We also support their Ascend program that is partnered with Chase. But these types of sessions, we really want to start doing more of. And so we appreciate Christina's investment and time of putting together this program, putting together the curriculum. We really appreciate you guys taking time. Thank you, Christina. We really want to spend more time really kind of like doing more of these. And so we'll keep inviting you guys, and if you guys can make it, great. And that's why we have scholarship funds. That's why we created our scholarship fund, so we can pay for these things. So thank you very much. But how about everybody just giving a 30-second observation of the program today? Huda.
Thank you, Christina. I'm coming from a very different background to business. This was definitely very useful and very informative. So thank you so much for taking time out of your day to conduct this.
Tom.
Oh yeah, thanks a lot. There's always, every time I go, there's always some little nuggets I get, and you just add to the chest, the tool chest of stuff we do. So it's good.
Hanifa.
Thank you so much, Christina. I think it was definitely a lot of information, and I definitely didn't get all of it, but I definitely got some things that really helped me. So I appreciate you.
Benny.
Yeah, as I said, it was a great course. I appreciate you guys inviting us from the East Coast. So thank you for that. Dr. Hundley, what school did you teach at in Columbus? I meant to ask you.
Oh, I didn't teach in Columbus. I taught in Maryland. I taught in Florida, Florida Institute of Technology. I taught military staff. It's there in Patuxent, Maryland. I've taught at the College of Southern Maryland, but no, not here in Ohio. I'm here visiting 2 beautiful grandchildren, and I was invited by Dion Henderson because we worked together on several projects.
Okay, awesome. I went to Denison, so I was just asking. Denison is right outside of Columbus, so I'm really familiar with the area.
Yes.
So, all right.
Yes. They just moved here, so I just got here.
Awesome.
Carla.
Thought it was very productive, very informative, great refresher. I recently accepted the manager of operations role for the council. So now I'm tapping into a little bit of working with our accountant. So it was very useful. Thank you.
Richard.
Yes, thank you, Christina. I'm trying to incorporate more financial analysis into my business and dealing with customers and clients. So this is very helpful. And again, it's hopefully just a start of my focus on accounting.
Excellent, thank you. Will. And don't just say good things because you're from UW.
Well, it's all going to be praising remarks to Christina, because I'm so glad you all had the time to be with her, because she's obviously got a lot of experience teaching working professionals, and it's not easy teaching accounting in an enjoyable and entertaining way, and she's really good at that. So really appreciate the fact that you've allowed us to be part of this. But also, Fernando, I have to give special thanks to you and the council for sponsoring this program and making this available to these companies. And again, I hope it's helpful for all of you participants that are here, but really appreciate our partnership and looking forward to continuing that.
Thank you, Will. Dr. Hundley.
I think I've said enough. I enjoy the fact that you're very, very animated with your presentation. It wasn't boring. I didn't go to sleep. I didn't want to leave. And I've been here since this morning. I actually rearranged my entire schedule when Dion said this was happening, because minority business is very important. We are, as far as I'm concerned, we're the pulse of this nation, small businesses. If it were not for us, there would be a lot of people unemployed. So I absolutely enjoy the fact that you broke it down well enough for a layman to even understand what managerial accounting is about. So I appreciate the way you present, and I know your students appreciate you at the university.
And Dr. Hunley, I'm going to piggyback on a comment that you made earlier today. We so appreciate Christina's, not only her academic,
Prowess.
A prowess, and I wanted to use that word. I wasn't making sure that I wanted to use it correctly, but also her private industry prowess, right? In terms of like the practical and the theoretical coming together, right, for the benefit of everybody here. And so, Christina, thank you so much for being with us today. Gabriela.
Yeah, can you hear me? I think my internet connection is a little unstable, but can you hear me now?
Yes.
Okay, yeah, so yeah, thank you, Christina. I always enjoy your sessions. For me also, it was very helpful because, as you all know, here at the center, we work with many small businesses and also with undergrad students. So again, the information, it was very easy to digest, as someone wrote in the chat. And yeah, thank you, Christina. It was a great session. And thank you, Fernando and Will, for organizing this.
Our pleasure, our pleasure. Dion.
Good afternoon, everyone. Yeah, Huda, thank you for bringing us into the MBE program. We appreciate your help in getting us through that. And Christina, this was really great. Fernando, same to you. I piggyback on what Dr. Hunley said. Having access to this information and this type of knowledge is key to small businesses. To be quite honest with you, Miss Essie's is just one of the companies that I facilitate with. We work with a lot of startup companies, 1 to 3, 3 to 5 year adopters. And the accounting portion, being able to evaluate, being able to understand those numbers, you will not exist without being able to project, being able to understand where you are in business. So to be quite honest with you, I think it should be a fundamental requirement for startup companies, businesses, all the way through. And I think one of the humbling things, and I commend everybody that's on here, is saying, I'm not sure, or I can do better, or flat out, I don't know. Because we can't be jacks of all trade. I've started all types of companies and been everywhere from A to Z. But at the end of the day, this type of ongoing training, it helps us be scalable. It helps us sustain where we're at. And Christina, you do a great service by having a skill set that you share. So I say thank you for myself, and I tried to have my entire team on this phone call today. I really appreciate you. Thank you.
Thank you very much.
Okay.
You have the last word.
This was too much. The real winners here are you all for being here the whole time, and for Fernando, Will, Hanifa for putting this on, Gabriela for your help too. So thanks everyone, team effort for sure.
Well, we appreciate it, and as Christina said, she'll be on the line for a few minutes longer if anybody has any questions. But
about 10 minutes.
Just want to say thank you to everybody for being here. Thank you, and stay tuned, because like I said, we're going to be doing more of these as we go forward. Appreciate it. Thank you, guys.
Thank you.
You guys ever get out Atlanta way, look me up. Coffee or lunch or something. I'd like to get to Seattle at some point out to Washington, but you come this way, let me know. All right. Thank you all.
Perfect.
All right.
Thank you,
bye.
buddy. Appreciate it.